And right now, millions of investors are making a decision. That could either protect their wealth or cost them everything. You see, there's a number circulating on Wall Street this week, a number that's causing serious people to make very unserious decisions. But here's what nobody is telling you. The data tells a completely different story, and by the end of this video, you'll understand exactly why. What's happening right now in silver may be the most important signal you'll see all year. Welcome to Black Silver, the one place where the numbers speak louder than the noise. Now, if you've been around long enough, you know that real wealth isn't built on panic. It's built on patience and precision. So if you're someone who's spent decades making serious decisions, someone who knows that information is the most valuable asset in the room. Do us a small favor today. Hit that subscribe button. Think of it like setting up a standing appointment with the one advisor who never tries to sell you anything, just the facts every single time. And one more thing before we begin. Drop a comment below and tell us, where in the world are you watching from today? Because this community spans every time zone, and every single one of you deserves to know what's really happening. Now, let's get into the data. It is the third week of February 2026, and across trading desks, investment forums, and private wealth offices, a single question is dominating every conversation. Is silver going back below $50? For some investors, that question carries the weight of months of careful positioning. For others, it feels like a trap door opening beneath their feet. And for the most disciplined minds watching this market right now, it represents something else entirely. An opportunity hiding inside a moment of manufactured fear. But before anyone can answer that question honestly, they have to understand exactly what is driving it. Because the story circulating this week did not begin with a fundamental shift in silver's supply. It did not begin with a collapse in industrial demand. It did not begin with a change in central bank policy or a sudden discovery of new silver reserves. It began with two words, max pain. Now, most retail investors hear that term and immediately imagine something sinister, a dark room, powerful institutions pulling levers, markets being moved by invisible hands against the ordinary investor. And while institutional influence in derivatives markets is very real, the concept of max pain itself is far more mechanical than it is conspiratorial. Here's what it actually means. Every month on the options expiration date, the market settles at a price. And that settlement price determines who profits and who loses on their options contracts. Max pain is simply the price level at which the greatest number of options contracts, both calls and puts, expire worthless. It is the point where the market causes the maximum financial loss to the maximum number of options holders. It is not magic, it is mathematics. And this week, that mathematical calculation is pointing toward a price level that has rattled a significant portion of the silver investing community. The number being cited, the level that options positioning suggests could act as a gravitational pull before Friday's expiration, sits dangerously close to territory that would represent a sharp reversal from silver's recent strength. That single data point, filtered through the anxiety of an already nervous retail market, became the headline, and the headline became the panic. But here is where serious investors separate themselves from reactive ones. They do not ask, is the headline true? They ask, what is the headline missing? Because every market narrative, every piece of financial fear content, every urgent warning that floods social media during expiration week is built on a selection of facts, not all the facts, a selection. And the facts that get left out are almost always the ones that matter most. Consider the environment this headline was born into. Silver had been building serious momentum through the early weeks of 2026. Institutional positioning had been shifting. Physical premiums at major dealers were quietly climbing above paper prices. Industrial demand forecasts were being revised upward. And the geopolitical backdrop, from energy transition pressures to defense spending cycles, was creating a structural case for silver that had nothing to do with short-term trading patterns. Then came expiration week, and suddenly, none of that mattered to the algorithm-driven headlines. None of that context appeared in the posts being shared thousands of times across investment communities. What appeared instead was a number, a threshold, a fear target, below $50. The investors who are most vulnerable right now are not the ones who lack money. They are not the ones who lack access to information. They are the ones who have spent years building a position, only to abandon it in the final hours before the picture becomes clear. History has seen this pattern before, not once, not twice, but repeatedly, in every major commodity cycle, in every expiration window that generated more fear than it ever deserved. The data knows this, and over the next 3 parts of this analysis, the data is going to speak for itself. There is a moment in every major market cycle where the price on the screen and the reality beneath it begin telling two completely different stories. Most investors never notice when that split happens. They are too busy watching the number move, too busy calculating what they have gained or what they stand to lose, and by the time they realize the story they were reading was never the real story, the opportunity has already passed them by. This is that moment. To understand what actually created the pressure on silver in the third week of February 2026, you have to go back several weeks. Not to a trading desk in New York, not to a policy announcement from Washington. You have to go to a calendar. Specifically, the Lunar New Year calendar. The new moon that officially kicked off the Lunar New Year landed at the end of January 2026. And what followed, as it does every single year without exception, was a multi-day closure of mainland Chinese exchanges. The Shanghai Futures Exchange went quiet. Chinese institutional buying, which had been one of the most consistent and powerful forces behind silver's momentum in recent months, temporarily stepped out of the room. Now, to the untrained eye, that sounds like a minor scheduling note, a holiday footnote at the bottom of a market report. But in the architecture of global precious metals markets, when China steps away, the entire plumbing of the system changes. Think of it this way. Imagine a river that is fed by 3 separate tributaries. 2 of them continue flowing normally, but the third, the largest and most consistent one, suddenly slows to a trickle for 10 days. The river does not stop moving. The water does not disappear, but the current changes, the pressure changes, and anything floating on that river begins behaving differently than it did the week before. That is precisely what happened to silver pricing during the Lunar New Year window. With Chinese institutional demand temporarily removed from the equation, the character of the market shifted, liquidity thinned. The hedging patterns that normally anchor price behavior during Asian trading hours became uneven, and into that thinned liquidity, the paper market moved with disproportionate force. This is the part that most retail investors never fully grasp. The silver price that appears on every screen, every app, every financial news ticker is not primarily determined by the buying and selling of physical silver. It is determined by the trading of paper contracts, futures, options, derivatives layered upon derivatives, and the ratio between paper silver and physical silver in the COMEX system is not 2-to-1 or 5-to-1. Conservative estimates place it significantly higher, meaning that for every ounce of physical silver that exists in registered COMEX vaults, there are dozens of paper claims representing that same ounce. During normal market conditions, that imbalance operates quietly in the background. The system functions because not everyone demands physical delivery at the same time. But during a window of thinned liquidity, when one of the world's largest physical buyers has temporarily left the market, that paper dominance becomes amplified. Prices can be moved with far less capital than would normally be required. And the directional pressure tends to favor whoever holds the largest short position. This is where the anatomy of the February pullback becomes genuinely instructive. The hard down days that rattled investor confidence during this period were not random. They were not the result of new fundamental information entering the market. No major supply discovery was announced. No industrial demand forecast was revised downward. No central bank made a policy shift that fundamentally altered silver's investment thesis. What changed was the temporary absence of the buyer that had been holding the floor. And when that buyer stepped away, even briefly, the paper market did what paper markets always do in moments of reduced resistance. It tested the downside. Not because the downside was justified by reality, but because the mechanics of the moment allowed it. Because thinned liquidity and concentrated short positioning created a window, and that window was used with precision. But here is what makes this moment critically important for serious investors. The test of the downside during a liquidity vacuum is not the same as a fundamental breakdown. These are 2 entirely different events. And confusing them is precisely the mistake that transfers wealth from patient hands into opportunistic ones. History has documented this pattern across every major silver cycle on record. The Lunar New Year window creates temporary price distortion, the expiration mechanics add gravitational pressure, and the combination produces a moment that looks, on the surface, exactly like the beginning of a collapse. But beneath the surface, something else entirely is being constructed. There is a particular kind of silence that exists in markets just before something significant moves. It is not the silence of inactivity. It is not the silence of disinterest. It is the silence of accumulation, the quiet, deliberate, almost invisible process by which serious capital repositions itself before the majority of the market understands what is happening. That silence is speaking right now, and the data, for those willing to read it carefully to these, is extraordinarily loud. Begin with the foundation that no amount of paper market manipulation can permanently alter. Physical supply. The Silver Institute, one of the most authoritative bodies tracking global silver flows, has documented consecutive years of structural supply deficits in the silver market, not marginal shortfalls, not rounding errors in an otherwise balanced equation, meaningful, measurable, and accelerating deficits between what the world mines and refines and what the world actually consumes. In practical terms, this means the world is using more silver than it is producing every single year. And that gap, rather than closing, has been widening as industrial demand enters a phase of expansion that the silver market has genuinely never encountered before in its modern history. This is not a speculative argument, it is an inventory argument, and inventories, unlike sentiment, do not lie. To understand why industrial demand is the variable that changes everything in this analysis, one must look beyond the traditional image of silver as a monetary metal, beyond the coins, beyond the bars stacked in private vaults, beyond the jewelry and the photography applications that defined silver's industrial identity for most of the 20th century. The silver that matters most in 2026 is the silver inside a solar panel. It is the silver inside an electric vehicle's battery management system. It is the silver coating the contacts inside a semiconductor. It is the silver embedded in the guidance systems of next-generation defense hardware. It is the silver threading through the infrastructure of a world that has committed, at the governmental and corporate level simultaneously, to an energy transition that cannot be completed without it. The numbers behind this demand are not projections built on optimistic assumptions. They are purchase orders, they are manufacturing contracts, they are government procurement schedules that have already been signed and funded. Solar panel production alone now consumes a volume of silver that would have seemed impossible to forecast a decade ago. And as panel efficiency standards continue rising, the silver content per unit is increasing, not decreasing. The same dynamic is playing out across electric vehicle production lines, across semiconductor fabrication facilities, and across defense procurement programs on 3 continents. Now layer onto that physical reality the institutional positioning story. The Commitment of Traders report, published weekly by the Commodity Futures Trading Commission, provides a precise map of who is positioned where in the silver futures market. And what that map has been showing in the weeks surrounding this expiration window is not the picture of a market preparing to collapse below $50. It is the picture of a market being loaded. Commercial hedgers, the category that includes the miners, refiners, and large physical market participants who understand silver's fundamental value better than any speculative trader, have been adjusting their positioning in a manner consistent with anticipated upside rather than sustained downside. Large speculators, the momentum-driven funds that typically amplify whatever direction the market is already moving, have been trimming short exposure precisely during the window that generated the most retail fear. That divergence is not accidental, it is institutional language, and it is saying something very specific to anyone fluent enough to read it. Then there is Shanghai. While Western financial media was constructing narratives around max pain and expiration pressure, the Shanghai Futures Exchange was quietly telling a different story through its warehouse data. Chinese strategic accumulation of physical silver, documented through import figures and exchange inventory movements, has been running at a pace that reflects long-term conviction rather than short-term speculation. China does not accumulate strategic commodities without a reason, and the reason, in this case, connects directly to the same industrial demand story unfolding across global manufacturing supply chains. A nation engineering the world's largest solar installation program, the world's largest electric vehicle production ecosystem, and a defense modernization effort of historic scale, does not reduce its silver holdings during a paper market pullback. It uses the pullback. This is the data point that reframes everything discussed in parts 1 and 2. The pressure was real. The mechanics behind it were real. The fear it generated in retail markets was absolutely real. But underneath that fear, underneath the expiration headlines and the liquidity vacuum and the hard-down days that shook investor confidence, the physical market was behaving in exactly the opposite direction. Premiums at major dealers were not falling. They were rising. The gap between what COMEX was printing as a paper price and what serious buyers were actually paying for physical silver in volume was quietly widening during the very same window that headlines were declaring a potential collapse. That gap between paper reality and physical reality is perhaps the single most important number in this entire analysis. Every generation of investors faces exactly 1 or 2 moments in their lifetime where the distance between what the market is saying and what the market is actually doing creates a window of opportunity so significant that the decision made inside that window defines the financial outcome of everything that came after it. This is one of those moments. The analysis conducted across the first 3 parts of this briefing was not assembled to generate excitement. It was not constructed to push a particular investment narrative or to provide comfort to those already holding silver positions. It was assembled because the data demanded an honest accounting, and that accounting has arrived at a conclusion that serious investors cannot afford to ignore. The pressure on silver during the 3rd week of February 2026 was real, But its origin was mechanical, not fundamental. The Lunar New Year liquidity vacuum created the conditions. The options expiration mechanics applied the gravitational force. And the paper market, operating with the disproportionate leverage that defines COMEX in periods of thinned physical participation, executed the move with precision. None of that changed the supply deficit. None of that changed the industrial demand trajectory. None of that changed the institutional positioning story documented in the commitment of traders' data. And none of that changed what serious buyers were actually paying for physical silver. At the very moment, retail investors were reading headlines about a return below $50. Now consider the historical record, because this moment, as unfamiliar as it may feel to those experiencing it for the first time, is not without precedent. Silver has moved through expiration-driven pullbacks before. It has navigated Lunar New Year liquidity windows before. It has survived concentrated short positioning, paper market pressure, and retail panic cycles before. And in every documented instance where the fundamental supply and demand picture remained structurally intact during those pressure windows, the outcome on the other side followed a consistent pattern. The investors who held their position, or quietly added to it during the manufactured fear, were the ones history remembered as having been correct. The investors who sold into the panic, who let the headline override the data, who confused a mechanical clearing event with a fundamental breakdown, were the ones who funded the next move for everyone who stayed disciplined. This is not speculation. This is the documented rhythm of commodity markets across multiple decades, and silver, more than almost any other asset class, has demonstrated this pattern with a consistency that should give every serious investor in this audience a very clear frame of reference for what they are watching right now. The Federal Reserve policy backdrop adds another critical layer to this decision point. Real yields, the inflation-adjusted return on government bonds, remain the single most important macro variable in determining silver's price floor. When real yields rise aggressively, silver faces genuine headwinds. When real yields plateau or decline, silver finds structural support that paper market mechanics cannot permanently override. The current Federal Reserve posture, navigating between stubborn inflation data and a slowing growth picture, does not present the aggressive real yield environment that would justify a sustained breakdown in silver prices. The Fed is constrained, and a constrained Fed, operating in an environment of structural commodity deficits and accelerating industrial demand, historically represents one of the most favorable backdrops silver has ever operated within. The floor, in other words, has more support beneath it than the headlines are acknowledging. So what does the serious investor actually do with this information? 3 variables separate the investors who build generational wealth from commodity cycles, from the investors who simply watch those cycles pass them by. Position, patience, preparation. Position means understanding exactly what you own and why you own it, before the moment of pressure arrives. Not during it, not after it, before it. Because the investor who enters a volatility window without a clearly defined thesis is the investor most likely to make a decision driven by emotion rather than analysis. Patience means understanding that the timeline of the paper market and the timeline of the physical market are not the same timeline. COMEX can print a number on a screen this Friday, but it cannot alter the fact that the world needs more silver than it is currently producing. It cannot accelerate mine supply. It cannot reduce solar panel manufacturing schedules. It cannot reverse the defense procurement contracts already signed. The physical reality operates on a longer clock, and the investor who aligns their patience with that longer clock, rather than the noise of expiration week, positions themselves on the correct side of that timeline. Preparation means having already decided, in advance, what a continued move lower represents. Not catastrophe, not confirmation that the thesis was wrong, but a deeper entry point into a structural story that the data continues to support. The prepared investor does not panic at $50. They have already done the analysis. They already know what the physical premiums are telling them. They already know what the institutional positioning data says, and they act from that knowledge, rather than from the fear that is currently driving the majority of retail decision-making. The question this video opened with, is silver going back below $50? Was never really a question about a price level. It was a question about mindset, because the investors who will look back at February 2026 with clarity and confidence are not the ones who predicted the exact bottom with perfect precision. They are the ones who understood what the data was actually saying. While everyone around them was only reading the headlines, the data has spoken. The decision now belongs to you.